Conventional mortgages are the most common type of home financing. These home loans don't come with any kind of government backing like you'll find with FHA and VA loans. Credit and financial requirements for conventional loans are usually tougher than what you'll find with the government-backed options. But buyers out there who have excellent credit and solid assets can often tap into great rates and terms with conventional financing. So let's take a closer look. Most conventional lenders out there will require at least a 5% down payment, although you might find some willing to go as low as 3%. Now, on a $200,000 home purchase, that 5% means you're coming up with a $10,000 down payment at closing. You can find a lender willing to do a loan at that 3% clip. That's a little bit better, right? That's a $6,000 down payment. But to qualify for the best rates and terms on conventional loans, buyers may need to come up with 20% of the purchase price. 20% of a $200,000 loan is a $40,000 down payment. Now, with most conventional loans, if you're putting down less than that 20%, so less than that $40,000 in this example, you're going to wind up paying private mortgage insurance every month. Now, the fee for PMI, as this is known, is based on your credit score, your loan-to-value ratio, and other factors. It's added to your monthly payment, and it's typically required until you build up 20% equity in your home. PMI fees can add anywhere from $80 to $100 or even more to your mortgage payment every month. I pay right around $100 a month for PMI. Now, conventional loans, talking about credit scores, credit requirements, these can also tend to be tougher to get than government-backed loans. Now, every lender is different with any type of home loan, but many conventional lenders will look for a credit score in the mid to upper 600s for that conventional financing. Now, buyers who want to have a shot at the best rates and terms on conventional loans, they'll often need a higher score, often more like a 740 FICO, to really have a shot at those top tier rates and terms. Now also, if you've had something like a bankruptcy, a foreclosure, or a short sale, it might take you longer to be eligible for a conventional loan than it would take you to be eligible for a government-backed one. And next, let's talk about interest rates. This is something that everyone wants to talk about, right? And interest rates is actually, it's an interesting one, actually. Average interest rates tend to run lower on government-backed loans than they do on conventional loans, and I think that surprises a lot of people. But again, keep in mind I'm talking about averages, broad averages. So homebuyers who have great credit, they might be able to get lower rates on conventional loans than they would with a government-backed loan. Every buyer situation is different. So next, let's talk about closing costs. This is another hot topic for buyers everywhere, right? So conventional buyers can ask a seller to cover some or all of their closing costs, but how much they can ask for can depend in part on how much they're putting down. Okay, so conventional buyers who have a loan-to-value ratio greater than 90% can ask sellers to contribute up to 3% toward their closing costs. And having a loan-to-value above 90 basically means if you're borrowing more than 90% of the home's value, you cap out at 3% in terms of what your sellers can pay. Now, if you're putting down more, if your loan-to-value is between 75 and 90%, that jumps up to a 6% that you can ask the seller to cover. Now, buyers who have a loan-to-value ratio below 75%, they can ask the seller to pay a whopping 9% toward their closing costs. But keep in mind that a loan-to-value ratio below 75% would usually mean you're making a 25% down payment, and that's not something that most people do. Now, a big benefit of conventional loans that the government-backed loans don't offer is that you can use a conventional loan to purchase a second home or an investment property. So you don't have to occupy the home you're buying as your primary residence. Now, you do with FHA, USDA, and VA loans in most cases. Now, it's important to know that if you're going to go this route, if you're looking at a non-owner occupied property, you very well may run into higher down payment and credit score requirements. It's not guaranteed, but it can absolutely happen. Be prepared for it. Now last, let's talk about assumability. So this is another way that conventional loans differ, and it's really not in a good way, unfortunately. Unlike the government-backed loan options, most conventional loans are not assumable, right? So you'll typically need to sell your home in order to get out from under the mortgage. You can't just have someone come in and assume your mortgage. Now, conventional loans offer qualified buyers an array of options, and they're available from most banks and lenders out there. Not every lender will make FHA or VA or USDA loans, and the widespread availability of conventional loans can make it easier for buyers to compare rates and terms. And that's a quick look at conventional mortgages.